Everyone loves the idea of receiving cash flow every single month, and the reality is that there is no form of income more passive than receiving dividend payments from the stocks in your portfolio. In fact, I've now spent over a decade focused on building out my dividend portfolio that on average pays me over $426 every single month. The end goal for my portfolio is to one day be able to live off my dividend income, and after extensive research over the years, I found that the most effective way to do this is actually not buying high-yielding stocks, but by buying quality dividend growth stocks. Dividend growth stocks are basically companies that have the ability to increase their dividend payouts every single year. For example, 10 years ago, Home Depot was paying out around 39 cents per share every single quarter, but jump forward 10 years to now, and they are now paying out $2.09 every quarter. That means they increased their dividend payments by over 5x during that period, or an average growth rate of around 18%. So in this video, I'll be revealing 10 companies that I believe could be a good option for building out a dividend growth portfolio in 2024. And while it's basically impossible to predict how well these stocks will do over the next year, these are companies that I believe will help myself and others achieve our long-term passive income goals. To analyze these stocks, we'll be using my stock valuation spreadsheets, which you can download on my Patreon page at the link in the description. Now let's dive into our first company. The first stock we're going to be looking at is actually an ETF that is the largest position in my personal dividend portfolio, and that is SCHD, the Schwab US Dividend Equity ETF. Now this fund is currently trading at $76.28 per share, and over the past year it's up around 0.5%. If we jump over to my do-it-yourself investor toolkit, if I go ahead and blow up my allocation chart, you can see this company makes up around 48% of my entire dividend portfolio. And if we jump over to my dividend dashboard, we can see right here SCHD is currently paying me around $2,580 every single year. So why am I so comfortable with SCHD being by far the largest position in my portfolio? Well, again, you have to remember the long-term goal with my portfolio is to one day be able to live off dividends, and SCHD has phenomenal dividend metrics. If we come over here, we can see their starting dividend yield sitting at around 3.5%, so a nice starting dividend yield. But again, the magic is when they increase those dividend payments over time. And if we look over a 10-year time period, we can see they went from paying out around 90 cents per share in dividends all the way up to $2.56, which is really solid dividend growth. We can see the 5-year dividend growth rate sitting at over 13% and the 10-year dividend growth rate sitting at over 11%. And keep in mind, anytime a company has a dividend growth rate that is below the rate of inflation, that company is technically paying out less in dividends every single year. So it's really important we buy companies that have solid dividend growth rates. And if we jump over to the holding tabs, we can see this is a very well diversified ETF. Back over on the summary tab, if we look at it over a 10-year time period, we can see it has done fairly well, up over 109%. And while I do believe valuing ETFs is quite a bit different than your typical stocks, let's go ahead and run it through a quick dividend discount model to see what we get. And the idea behind a dividend discount model is we value a company based on how much they pay out in dividends and how much those dividends are increasing. So I plugged in those yearly dividend payments so we can see those growth rates year over year. Moving forward, I'm projecting a simple dividend growth rate of just 5.75% and a discount rate of 9% for this fund, and that gives us a dividend discount model price per share of $86.55, and the current trading price for this company sitting at just $76.30, indicating it may be slightly undervalued. And to be fair, I truly think a dividend growth rate of 5.75% for SCHD is probably a little bit on the low end. I think they're capable of dividend growth rates much higher than that. But let's go ahead and move on to our second company. The second stock we're going to be looking at is my favorite real estate investment trust, and that is Vici Property, stock ticker VICI. This company is currently trading at $31.82 per share, and over the past year it's down around 2.75%, and year to date it's barely up around 0.22%. Now this company has a very nice starting dividend yield sitting at around 5.24%, and again, if we look at that dividend history, we can see they have a history of increasing those dividend payments over time. 5 years ago they were paying out around 16 cents per share. Jump forward to now, they're now paying out 42 cents per share, so very solid dividend growth over that time. Now the big question is, how safe are those dividend payments? So if we jump over to the dividend safety tab, what we want to do is scroll down. Now again, we're looking at a real estate investment trust. So when you're looking at a real estate investment trust, you actually don't want to look at the dividend payout ratio. What you want to do is look at the AFFO payout ratio. An AFFO payout ratio just gives us a better idea of how safe those dividend payments are. And if we come over here, we can see forward looking, it's sitting at around 74%, and for the trailing 12 months, around 76%. So overall, that's a decently healthy range for a real estate investment trust. So the dividend metrics for Vici Properties do look great, but the magic really kicks in when you dig into the company just just a little bit deeper. VICI Properties is one of the largest owners of gaming, hospitality, and entertainment destinations in the United States, and almost all of its real estate is located on the iconic Las Vegas Strip. So we're talking about some of the highest quality real estate in the entire United States. And while that's great, what I really love about the company is the way they have set up their lease structure. VICI Properties operates as a triple net lease REIT. And triple net leases are when the tenant is responsible for paying all of the property's expenses, including real estate taxes, building insurance, and maintenance. This makes triple net lease REITs very attractive to investors because they offer a steady stream of income with little risk, and the income is very predictable. To me, this gives VICI a huge advantage over its peers, and if we scroll down even further, we can see some other phenomenal metrics like the fact they were able to collect 100% of their rent in 2020, which was not the case for many REITs. If we scroll down even further, this is one of my absolute favorite things about VICI Properties. We can see, as of right now, 50% of VICI's rent roll has CPI-linked escalation. And basically what that means is 50% of their rent is protected from the risk of inflation, and they're projecting that by 2035, 96% of their rent will be protected from inflation. Again, another huge advantage for this REIT. Now, from a valuation perspective, again, there's a lot to like about this company. If we come over to my REIT valuation spreadsheet and plug in VICI right here and hit enter, we can see all this data will go ahead and load in. We'll go ahead and look at two different valuations. And the first we'll look at is the AFFO multiples valuation. Basically what we're doing is we're looking at some comparable REITs and looking at their stock price and price to AFFO multiple. They have an average price to AFFO multiple of around 19.07. VICI's price to AFFO is currently sitting at 13.35, an indicator that they may be a little undervalued. And when we plug this into our formula, we can see we come to an intrinsic value of $45.47, quite a bit higher than that current trading price. Now, just like we looked at with SCHD, let's run them through a dividend discount model. And again, we plug in the quarterly and the yearly dividends so we can see those dividend growth rates. I'm projecting a dividend growth rate for VICI of around 4%, and with a discount rate of around 8.5%, we come to an intrinsic value of $38.36. Again, an indicator that VICI may be undervalued. The third stock we're going to be looking at is actually a company I've never talked about on the channel before, and that is Louis Vuitton, stock ticker LVMHF. This company is currently trading at $820 per share, and over the past year, it's actually up around 13%, and year to date up around 10%. Now, this company is actually something I mentioned on Twitter just the other day. Their founder, Bernard Arnault, is now the second richest man in the entire world with a net worth of over $200 billion, and the key to his wealth has been his ownership stake in Louis Vuitton. And my favorite quote from him is, "Luxury goods are the only area in which it's possible to make luxury margins." Let's go ahead and put that quote to the test. If we jump over to the financial statement for Louis Vuitton and look at the income statement right here, we can see the revenues. They've seen really good revenue growth over the past decade, but what do those margins look like for those growing revenues? Well, if we jump over to the profitability tab, we can see gross profit margin for the trailing 12 months for Louis Vuitton sitting at 68.72%. That's absolutely phenomenal profit margins. So if we jump back over to the financial statements and look at the income statement, we can see a large majority of those revenues were able to find their way into the net income. And if we look at the net income growth over the past decade, it's been phenomenal, going from around $4 billion all the way up to over $17.5 billion for the trailing 12 months. Now, if we jump back over to the summary tab, one of the things I will point out is the starting dividend yield for this company quite a bit lower than the other companies we've looked at, sitting at around 1.66%. And this company actually pays out dividends semi-annually. So if we scroll down, you can see that means they only pay out twice a year, and the dividend payouts actually fluctuate quite a bit. The first dividend payment for the year is typically a little bit larger than the second dividend payment. Now, this isn't something I typically like to see. I like to see growing dividend payments, but what's really impressive about this company is if we look at this dividend growth rate. If we look at the 3-year dividend growth rate sitting at 36%, that's absolutely phenomenal. And the 5-year sitting at 16%, and the 10-year dividend growth rate sitting at 13%. So this company has definitely been rewarding their shareholders with massive dividend growth over the past decade. Now, from a valuation perspective, let's go ahead and run them through a dividend discount model. Assuming a dividend growth rate of around 7.25% and a discount rate of 9%, we come to a dividend discount model price per share of $835.32, a little bit higher than that current trading price of around $820, meaning it may be slightly undervalued. The fourth company we're going to be looking at is the highest yielding dividend stock in my portfolio, and that is Altria Group, stock ticker MO, and this company is currently trading at $40.18 per share, and the past year has been a rough one for them. They're down around 11.8%, and year to date around 11.4%. This company's starting dividend yield sitting at 9.72%. And there aren't many companies that I feel comfortable investing in with that high of a starting dividend yield, but I'll tell you why I hold MO in my portfolio. First off, if we jump over to my do-it-yourself investor toolkit and jump over to my dividend dashboard, you can see right here, Altria is currently paying me around $333 every single year in dividend income. If we look at the dividend history for this company, we can see they're what's known as a dividend king, meaning they've been increasing their dividend payouts for over 50 consecutive years. That's pretty phenomenal for a company with a high starting dividend yield. We can see 10 years ago, those dividend payments were around 44 cents per share quarterly, but jump forward to now, it's all the way up to 98 cents per share every single quarter. So keep in mind, again, a high starting dividend yield, and the dividend growth rates are decent for a company with a very high starting yield, sitting at around 4.14% for the 3-year dividend growth rate, 5-year dividend growth rate of over 5%, and the 10-year sitting at 7.63%. So again, decent dividend growth for a company with a very high starting dividend yield. Now, the big question whenever you see a company with a very high starting dividend yield is, are those dividend payments safe? So if we jump over to the dividend safety tab, at first glance, it looks like these dividend payout ratios are really not in a range that we would like to see, sitting close to around 77 to 80%. But again, I want to look at the cash flow payout ratio because that tells us how much free cash flow is being used to pay out dividends. If we look right here forward looking, it's sitting at around 82.66%. Again, that's typically quite a bit higher than I typically like to see it. But after doing a little more research, we can see Altria's objective has actually been to have a dividend payout ratio target of around 80% of adjusted diluted earnings per share. So if we jump back over to Seeking Alpha, we can see as of right now, they're actually right at where management's target payout ratio is. Their payout ratio is actually sitting right where their management team wants it. The management at Altria has collectively decided that the best way to reward their shareholders is in the form of dividends. So while the payout ratio is a little bit high, that's actually what they want to do to reward shareholders. Now keep in mind, this does mean you probably won't see much share price appreciation moving forward, but again, they have a very high starting dividend yield with decent dividend growth, and management has also stated that they're seeking out mid to single digit dividend growth per share annually. Now let's go ahead and jump over to my stock valuation spreadsheet. We'll come up here and plug in MO and hit enter, and we can see all of this data will automatically load in. Analysts currently have a target price of around $46.31, and the beta is sitting at 0.66, so you shouldn't see very much volatility from this company. Now in Altria's scenario, we'll look at 4 different valuations quickly. The first one will be Graham's valuation. This is basically a valuation model invented by Benjamin Graham, and it projects intrinsic value based on earnings per share growth. So after I plug in all of these variables into this formula, you can see we come to an intrinsic value of around $50.70. Moving forward, we'll look at our discounted cash flow analysis, and basically this is a projection based off how much future free cash flow the company will produce. And after plugging in all of these variables into my model, you can see we came to a discounted cash flow price per share of $59.71, assuming free cash flow growth of around 3.5%, which really isn't that high. Now the next valuation we look at is the multiples valuation, and again, we're seeing how the market is valuing companies that are similar in structure using a price to earnings multiple. So here's our comparable companies that have an average PE of around 12.63. So when we apply that average price to earnings to Altria, we come to an intrinsic value of $67.50. And with our dividend discount model again, assuming just 2.5% dividend growth and a discount rate of 9%, we come to a dividend discount model price per share of $61.82. So when we jump over to the output tab, we can see our 4 valuations, and when we average them all 4 together, we come to an intrinsic value of $59.90, quite a bit higher than that current trading price. The 5th company we're going to be looking at is one of my absolute favorite dividend growth stocks, and that is Visa, stock ticker V. If we jump over to Seeking Alpha, we can see they're trading at $258.93 per share, and they've had a very solid 2023 over the past year, up around 25.6%, and year to date, up almost 25%. Now this company is extremely different from Altria Group, which we just looked at. Their starting dividend yield is actually sitting below 1%, sitting at 0.8%. So I know what you're thinking. Why in the world for a dividend portfolio would you buy a company with a starting yield sitting below 1%? Well, let me go ahead and show you why. If we jump over to the dividend history tab for Visa and look at the past 10 years, we can see unbelievably high rates of dividend growth. They went from paying 8 cents per share every single quarter all the way up to now sitting at 52 cents per share every single quarter. So if we jump over to the dividend growth tab, we can see the 3-year dividend growth rate sitting at over 15%, the 5-year dividend growth rate sitting at 16.27%, and the 10-year dividend growth rate sitting at over 18.33%. That is what I call rapid dividend growth. Now, what's really phenomenal about this company is if we jump over to the dividend safety tab and scroll down, we can see their cash flow payout ratio. For the trailing 12 months, it's sitting at around 18.76, and forward-looking sitting at around 17.83. Now, I always say there are 5 different things a company can do with free cash flow. They can reinvest back into the business, they can pay out dividends, buy back shares, pay down debt, or pursue mergers and acquisition. So when a company only has to use around 18% of their free cash flow to pay out dividends, that means they can reinvest massive amounts of capital back into the business, allowing the business to grow and in turn growing those dividend payments at a rapid rate. So with that being said, I think we'll continue to be able to see very high rates of dividend growth from this company. Now, if we jump over to my do-it-yourself investor toolkit, I'll go ahead and blow up my growth tab, and I will say I have already seen very nice gains from Visa in my personal dividend portfolio. I'm currently up around 30% on this position, but let's go ahead and jump over to my stock valuation spreadsheet. The first valuation we'll run it through is Graham's valuation, and again, after plugging in these variables, we come to an intrinsic value of around $182 per share. Moving forward and looking at our multiples valuation, you can see the comparable companies we're using right here. They have an average price to earnings of around 32.23. So if we apply that PE to Visa, we come to an intrinsic value of around $276 per share. The last valuation again we'll look at is the dividend discount model. And assuming a dividend growth rate of around 7.75% and a discount rate of 8.5%, we come to a dividend discount model price per share of $298.83. So when we jump over to the output tab, we can see the 3 valuations used in this scenario. Averaged together gives us an intrinsic value of $252.66, just a little bit below that current trading price, but it is very close. So it looks like it's trading pretty close to fair value. The 6th company we're going to be looking at is one of the largest in my personal portfolio, and that is Microsoft Corporation, stock ticker MSFT, trading at $374.07 per share. In 2023 was a phenomenal year for the company. They're up over 57% in the past year, and year to date up over 56%. Now, this is another company with a very low starting dividend yield, sitting at around 0.8%, but once again, just like you may suspect, a phenomenal history of increasing those dividend payments over time. 10 years ago, going from 23 cents per share, jump forward to now all the way up to 75 cents per share every single quarter. So when we look at those dividend growth rates, we can see 10% for the 3 and 5-year dividend growth rates and 11% for the 10-year. If we jump over to my do-it-yourself investor toolkit, we can see this is a company that makes up around 8% of my entire dividend portfolio, the 2nd largest position, and like I mentioned, I've seen phenomenal gains from this company. We can see right here, I'm up over 41% on this position. And again, if we go over to the dividend safety tab for this company, we'll see very healthy range of cash flow payout ratio, sitting at around 21% for the trailing 12 months and 20% for the forward-looking cash flow payout ratio, meaning lots of capital is left over to reinvest back into the business, in turn growing those dividend payments over time. And if we jump over to my valuation spreadsheet, we'll go ahead and look at our first valuation again, which is Graham's. I'll go ahead and zoom in, and you can see we come to an intrinsic value of $240.88 with our discounted cash flow analysis, intrinsic value of $327. And if we jump over to our dividend discount model, we come to an intrinsic value of $433 per share. So when we jump over to the output tab, we can see we come to an intrinsic value of around $333. Now, the current trading price is sitting around $374. So it does look like at its current trading price, the company may be a little overvalued, but I still think this could be a very solid long-term play. The 7th company we're going to be looking at is Realty Income Corporation, stock ticker O, and this company is currently trading right at $58 per share. And again, this is a real estate investment trust. Over the past year, they're down around 9.5%, and year to date down around 9%, and they have a very nice starting dividend yield sitting at 5.33%. Now, this company is actually known as the monthly dividend paying company, and they've been increasing dividend payments for over 25 consecutive years. So again, they pay out dividends every single month, and we can see 10 years ago they were paying out around 18 cents per share, but jump forward to now, all the way up to around 26 cents per share every single month. If we jump over to the dividend growth tab, we can see pretty decent dividend growth for a company with a nice starting dividend yield. We typically don't see as high of dividend growth rates from real estate investment trusts, but the 3-year dividend growth rate coming in at around 4%, 5-year at 3.67, and the 10-year close to around 4%. Now again, like I mentioned earlier, when we look at a real estate investment trust, we actually don't want to look at the payout ratio. What we want to look at is the AFFO payout ratio. That gives us a much better idea of how safe those dividend payments are. And for Realty Income, it's sitting at around 75% forward looking and around 76% for the trailing 12 months. So again, a pretty healthy range for a real estate investment trust. Now this is another example of a company that I own in my personal dividend portfolio. If I blow up my allocation tab, we come over here, we can see Realty Income makes up about 3.6% of my personal dividend portfolio. If we jump over to my REIT valuation spreadsheet, we'll go ahead and plug in the stock ticker O and hit enter, and all this data will automatically load in. Analysts currently have a target price of around $61 per share, and the beta is sitting at 0.9, so you should see pretty low volatility with this company. Now the first valuation we'll look at is the AFFO multiple, so I'll go ahead and zoom in, and after comparing it to these comparable companies, we come to an intrinsic value of around $68.84. Now the next valuation we use is the historical price to FFO valuation, and basically what this does is it compares where the company's been valued over the past decade compared to where it is right now. And for the trailing 12 months, we can see the price to FFO for Realty Income sitting at about 14.25, but on average over the last 10 years, it's been sitting at 18.7. Again, an indicator it may be undervalued. Now, the last one we'll look at, again, the dividend discount model. You should be familiar with it by now. But if I zoom in, you can see assuming a dividend growth rate of 3.5% and a discount rate of 8%, we come to a dividend discount model price per share of $70.66. So when we jump over to the output tab, we can see with the two valuations that we used here, we come to an intrinsic value of $69.75, a decent bit higher than that current trading price, meaning it may be undervalued. Plus, you get a great starting dividend yield, phenomenal history of dividend payments, and dividends every single month. The eighth company we'll look at is Waste Management, stock ticker WM, and they're currently trading at $177.75 per share. And this is actually the most recent addition to my personal dividend portfolio. And if I blow up my growth tab, you can see I'm already up around 17.3% on this position. Over the past year, this company's up around 11.4%, and year to date, up at a little over 13%. Now, the starting dividend yield for Waste Management is only sitting at around 1.58%. And to be fair, they do have a solid dividend growth history, as we can see here. Good job increasing those dividends, but if we jump over to the dividend growth tab, the dividend growth rates aren't anything too crazy. The 3-year sitting at 8.7%, 5-year sitting at 3.37%, and the 10-year sitting at 6.73%. So with an average dividend yield and average dividend growth rates, why would I want to add this position to my personal dividend portfolio? And I'll make it very clear why. This company is extremely recession resilient and has very predictable revenue, free cash flow, and dividend growth in the future. And this is all laid out in the investor's presentation for Waste Management. We can see 75% of their revenue has annuity-like characteristics. And if we jump over to the 26th slide in this presentation, we can get a great idea of their capital allocation plan. We can see the company is currently focusing on paying out around 40 to 50% of their free cash flow in the form of dividends, and they have 19 consecutive years of dividend increases. They're actively pursuing mergers and acquisitions and buying back large amounts of their stock, with over 1.5 billion of their stock repurchased in 2022. If we jump over to my stock valuation spreadsheet, we'll go ahead and come up here and plug in stock ticker WM and hit enter. The first valuation we'll look at is the discounted cash flow analysis. I'll go ahead and zoom in here, and we can see we came to an intrinsic value of around $160 per share. With our multiples valuation, we came to an intrinsic value of $192 per share. And with the dividend discount model, assuming 7% dividend growth and 8.5% discount rate, we came to a dividend discount model price per share of $199.73. So on the output tab, we can see our three valuations. We came to an intrinsic value of $184, a little bit above that current trading price, meaning it's pretty close to fair value. The ninth company we'll be looking at is Home Depot, stock ticker HD. If we jump over to Seeking Alpha, we can see they're currently trading at $348.53 per share, and over the past year, they're up around 9%, and year to date, up a little over 10%. Now, what's interesting is if we look at the 10-year chart, we can see they've had a phenomenal decade, up over 326%, way outperforming the S&P 500. If we look at that starting dividend yield, it's pretty solid, sitting at around 2.39%, but the dividend history is extremely impressive for this company. If we scroll down, we can see 10 years ago, the company was paying out around 39 cents per share. If we jump forward to now, it's now sitting at $2.09 per share every single quarter. So when we look at the dividend growth rates for this company, we can see the 10-year dividend growth rate extremely high, sitting at 18.28, the 5-year sitting at around 15.2, and the 3-year dividend growth rate sitting at 11.7. If we look at the dividend safety for this company, again, we'll look at that cash flow payout ratio right here, sitting at around 42.65%, meaning around 42% of Home Depot's free cash flow is being used to pay out dividends. Now, if we jump over to the stock valuation spreadsheet, the two valuations I want to run it through are the discounted cash flow analysis and the dividend discount model. So I'll go ahead and zoom in, and you can see after plugging in all of these variables, we come to an intrinsic value of around $326 with the DCF model, and with the dividend discount model, we come to an intrinsic value of around $356.14. So when we jump over to the output tab, we can see our two valuations come to an average of around $341.05, just a little bit below that current trading price, so it is pretty close to fair value. The 10th and final company we're going to be looking at is one of my absolute favorite dividend growth stocks of all time, and that is Broadcom, stock ticker AVGO. And if we look at Seeking Alpha, we can see they're currently trading at $1,126 per share, and over the past year, they are up a massive amount, over 100%, and year to date up over 103%. If we jump over to my do-it-yourself investor toolkit and look at my growth tab, to no surprise, you can see I'm up around 120% on this position. And while those gains have been phenomenal, what's just as impressive is the dividend growth this company has seen over the past decade. We can see the starting dividend yield right now is sitting at only 1.86%, but if we jump over to the dividend history for this company, we can see massive dividend growth. They went from paying 19 cents per share every single quarter all the way up to $5.25. To show just how crazy that dividend growth has been, let's go over to the dividend yield tab, and if we scroll down, look at that dividend yield on cost. This means if you bought the company 10 years ago, your dividend yield on cost would be close to 40%. Imagine getting $400 payments every year from a one-time $1,000 investment. That's basically what you'd be getting if you bought Broadcom 10 years ago. So if we jump over to the dividend growth tab, we can see the 3-year dividend growth rate sitting at 12.6, the 5-year sitting at 19.25, and the 10-year dividend growth rate sitting at an astounding 36%. If we jump over to the dividend safety tab, we can see they've been able to maintain all of this while having a cash flow payout ratio of just 42.28%. So again, phenomenal gains from this company and phenomenal dividend growth, and this is only made possible by growing free cash flow. And if we jump over to my stock valuation spreadsheet, if we look at Graham's valuation, I'll go ahead and zoom in, and you can see after plugging in all of these variables, we come to an intrinsic value of around $908 per share. If we jump over to our discounted cash flow analysis, we come to an intrinsic value of around $1,017 per share, and the last valuation we'll use is the dividend discount model, and assuming a growth rate of 7.25%, discount rate of 9%, we come to an intrinsic value of $1,127 per share. So we jump over to the output tab, we come to an average of around $1,017, which is a little bit below that current trading price, but you better believe if this company comes down to a more fair value, I'll definitely add more shares to my portfolio. So there you go, those are 10 dividend stocks I believe could be good options in 2024. Again, it's nearly impossible to know how these companies will perform over the next year, but what I do believe is that these companies should be able to grow their underlying metrics such as earnings per share and free cash flow per share, which in turn will allow them to grow their dividend payouts every single year. The end goal of my personal dividend portfolio is still to one day be able to live off dividends, and I think these options will allow me to one day do that. If you'd like to join a community of dividend investors and get access to all of my spreadsheets, then you can head over to my Patreon page at the link in the description. You can also get a huge discount to Seeking Alpha at my link in the description. And lastly, if you'd like to learn more about dividend growth investing and how to live off dividends, then you can sign up for my free weekly newsletter. Again, link in the description. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.